Are the tried and true principles of investing success dead in the water in 2021? Time to think like an investor. Do you know what I find comical? There was probably some guy in the early 1900s who bought like 1,000 horses just as the Ford Model T was picking up. Like someone decided, I'm gonna get like 1,000 horses because I'm selling these things like crazy. And then all of a sudden there were like roads and cars and he's like, I have 1,000 horses and nobody wants these things, right? Like over time, this is kind of how the world goes on. We have these conversations day in and day out about, is automation gonna take our jobs? It's like everything is becoming so advanced and so technological. What happens when Elon Musk is building a semi-truck that can drive from one place to another without a semi-truck driver? There are millions of semi-truck drivers. But one thing that we don't really think about a ton is the fact that, well, at a certain point, the candle business is probably a lot bigger, and then it got replaced by light bulbs. And every single industry that there is eventually gets replaced by something newer and better and different. And hey, we're still here, we're still alive, and we're doing better than we ever have. So this is that part of capitalism, that creative destruction. I mean, it's better than destructive destruction. At least you're getting newer products and better services over time. It's this idea that, things become obsolete as we innovate and as the world changes. I mean, look at these. You see these? I bought this iPad. These are headphones with a cord on them. This thing was like $2,000. I can't even plug it into here. These are obsolete. These are done, right? I mean, imagine the company or the guy who founded those bars you used to put across your steering wheel so no one would steal your car, right? Like these are things like a Walkman. We had them as kids, we saw them all the time, and now they're just completely gone. Now, the tricky thing about things going obsolete is that it requires adjustment, right? In the early 1900s, there were surely parents out there teaching their kids how to ride horses because they had to get around. Now, the painful part of obsolescence is like that adjustment period, right? Because, parents were probably teaching their kids in the late 1800s how to ride horses and how to get around, whereas maybe if they had the foresight and the understanding, they would have decided to maybe teach them how to drive a car because that's where the world was going. Now, the question is, this idea of obsolescence, it makes things tricky because we want to learn from the wisdom of the past. We want to read the people before us and take lessons from history and apply them to our own life. But can obsolescence apply to knowledge and to wisdom and to principles? And most importantly, can obsolescence apply to investment strategies? Are there investment strategies that would have worked for all of the past, but all of a sudden now don't? Do investment strategies and the way we manage our money go obsolete? That's an important question because we don't want to spend our entire lives in the wrong strategy. Now, let's take a prime example. Every young buck, when they get started and interested in the world of investing and finance, gets this book. And if they don't, you're about to get it. Trust me. Everybody recommends The Intelligent Investor. It's one of the greatest books on investing of all time. In fact, it even says the definitive book on value investing. And you know what? There's so many good principles in here. There's so many great lessons we can learn. And this was like the first real book on investing I ever started to read. And of course, to someone who's got their teeth cut a little bit, I would recommend that they take a look at it because there are timeless principles, things like differentiating between what's investing and what's speculating, using a margin of safety. But where people get a little tied up is they look into the tactics, right? The absolute basis. For instance, Warren Buffett in his old ways will have said something like, never look at a stock that has a price to earnings ratio over 20. Or make sure that a company has twice as much equity as it has debt. Or make sure the quick ratio is yada, 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 right? And what we do is we internalize these numbers. And as young investors, I did this for sure. I went around looking at different investments to pick according to Buffett's formula. But the thing is, does this change over time? Does the world change in a way that we can't really rely on these things anymore? I mean, it's tricky because value investors, people who followed books like this, have done incredibly well over the past 100 years. Value investing has worked and it's done a fantastic job. But what we've seen over the last 10 years is that it's starting to lag. And this is probably the way that your parents and your grandparents and a lot of people have been taught to invest. Find a reasonably good company and make sure that you pay a very, very low price for it so you get a good deal and make sure that it's got, good metrics in terms of the balance sheet of the income statement and all of these prudent investing principles. But then enter like the 2010s. Look at how value investing like this, has done relative to growth investing over the last 10 or 12 years. It's insane. It's absolutely getting decimated. So we have a 10-year span where all of a sudden this isn't working so hot anymore. And there's been historical periods where it doesn't do too well. The tricky part is, how do we know when something is completely obsolete or if it's just in a period that it's out of favor? But look no further than 2020 and 2021. What do we have now? All the stocks that don't make any money are skyrocketing. We have things like GameStop and AMC and people becoming millionaires, riding these hot names that really have no purpose and really wouldn't fit into the scope of this philosophy whatsoever. We have things like cryptocurrency, which we would consider speculation and not really an investment, taking off and making people fantastically rich. And above all of that, forget all of that kind of stuff like NFTs and whatnot, even just growth investing in technology companies that are even overvalued by value investing standards, has done unbelievably well. So we're now kind of left guessing, has the world changed to a point where these old strategies, this wisdom that your grandparents and your parents talk about investing, is kind of gone? So all of you aspiring investors and advisors out there, I want to talk about something called the Shiller PE ratio, which what we use in the financial industry a lot of the time to measure where is the valuation of the overall market. Are things really expensive and overvalued and we're paying too much for stuff right now as a whole? Or are things really cheap, like it's crashed and now we can pick things up for really cheap prices? So let's take a look at this. This is the Shiller PE ratio, and what it does is it adjusts for different cycles. It kind of smooths out the line of the average price to earnings ratio for the total S&P 500. So what that means is we're taking the stock market as a whole and looking at how much price do we have to pay for every dollar of earnings. That's a great way to think about value, right? What am I getting out for what I am paying? What is the value? And what we see is some pretty interesting information here. We see a graph that is continually moving upwards and upwards and upwards. If we had looked, for instance, take a look at this chart, from maybe 1900 to even 1990. If we look at that 90-year span, the average for this is probably somewhere around a 15 price to earnings ratio. And it bounces around and it kind of oscillates. But then something happens, right? Something happens in the 90s where this takes off. And if you look at the average between 2000 or 1990 and now, it is significantly higher. And even though we have massive crashes like the dot-com crash and the Great Recession, this thing continues to climb and climb and climb. So, according to this book or old investing principles, this means that the market's overvalued, and it's been overvalued for 20 years. Is that really true? Can that be the case, that markets have been overvalued for that long? I want to have a discussion about why this might be and if it renders all that wisdom of the past kind of completely unnecessary. One thing that you need to know about something like a price to earnings ratio is that people would be willing to pay more in price for a dollar of earnings of a company depending on what its future prospects look like. You might have a company where you're paying a very small amount in price for a very large amount of earnings, but if it's just going to decline into misery and then die off as a company, there's no point in buying it even if it's cheap. So essentially what we see is companies that have the potential for really high growth tend to have a higher PE ratio, and companies that are a little more stagnant and just kind of subsisting tend to have a lower PE ratio. That tends to be the situation, right? So let me give you an example. Let's say you're out there, you got $1,000 and you want to invest in, lemonade stand, let's call it. The easiest example we could find. You have one of your buddies, Bob, who is starting a lemonade stand, and you got one of your buddies, Jerry, and he's starting a lemonade stand, and you kind of go to your parents and your grandparents or maybe their advisor and say, hey, I got $1,000. I kind of want to throw into one of these ventures. What should I be looking at? What advice would you give me? And they might say something like, well, make sure that you never spend more than $500 for a lemonade stand. And you're like, okay, that's a good metric. I'll make sure that I don't overpay. That's a good way to think about it, right? So you go into the market and you see your buddy Bob, and he's hand pressing lemonade and stirring it up, and there's not many customers coming by, and he's giving them away, but he's not doing very well. But he's selling his lemonade stand. He can sell you a share in it for $400. And you're like, huh. Well, that meets the criteria, right? That meets the criteria because I'm paying less than I should. I'm buying something for really good value. But then you go look at Jerry, and Jerry's got like an automated machine that's just like crushing up lemons, stirring them up, kicking them out, and just got an assembly line that's tossing out lemons. And all of a sudden he's got this really advanced system that's all of a sudden just revolutionizing the way that lemonade is made. But he wants $2,000 for a share. So now you're in this conundrum. Do I go with the value pick, which is maybe not as hot of a business for way less of a price and more value, or do I overpay for something that might have more of a future? And that is really the conundrum we're at in the investing world, is a lot of people aren't really sure if that value investing style, this, is really worth it anymore because it's been underperforming so long and we see valuations so high in the markets. What is this all about? Well, that's exactly the point. This is a good analogy of how our world has actually moved. The biggest businesses in the stock market used to be railroads and utilities and these really heavy industrial companies with assembly lines and capital and all these expensive things and thousands of employees. Whereas now, the biggest companies are companies that have like infinite scale. Think about Microsoft, right? They build the software once and they sell it a million times.
Microsoft.
A company like Stripe, which is an online payment processor. It's a software company that has its fingers all over the internet. Companies like Shopify, people who are building digital products and software that are solving major issues for the world and have these massive valuations. Companies that don't really require that slow growing capital expenditure heavy business and are actually just very quick to grow and scale and can absolutely explode. It was very rare that a company early in the 1800s or 1900s could scale over a 5-year period like a Facebook can or an Instagram can. They wouldn't have been able to grow that fast over time without the world that we have now and the technology that we have now. So all of this being said, so there's a case to be made that value investing and the way our parents invested is on the way out, or maybe at least the way that we measure value is on the way out, and we need to rethink how we think about value investing and all those sorts of things. Because if I had been telling you about value investing and then you see what's happening with GameStop, AMC, and Bitcoin, you'd think I'm an idiot. You would think, man, this guy has no idea what I'm doing. So what's the big lesson here? I think the big lesson here is that when you read about history and you try to learn from the wisdom of the past, you don't want to extract the tactics, you want to extract the principles. You want to extract the philosophy and the thinking that got this strategy to a productive place, like value investing, for instance. Instead of thinking about getting a stock that has the right PE and the right debt to equity ratio, maybe thinking more about what were the principles. Buying a company that has future potential, buying a company that's run by great people. So all that being said, guys, I think there is some sort of shift happening, and this is going to happen. It is very possible that investment strategies over time will go obsolete. You want to make sure that you have some portion of your investments that's going to perform well regardless what certain strategies do. If you have exposure to the entire world and you're in stocks and you're in a good asset allocation, that way you don't have to be betting on whether value is going to beat momentum or whether this strategy is going to be that strategy. What you have is something that's robust and durable and doesn't require that you bet on the outcome of something for the success of your future. So anyways, guys, that's been my massive rant on what's happening with value investing. At heart, I love that book. I'm a massive value investing guy. That's where I started. But it's important not to become a zealot and get too obsessed with one particular thing because things become obsolete. Anyways, thank you so much for watching this video. If you liked it whatsoever, make sure to hit that like button, hit subscribe, and turn on post notifications for more videos just like this one every single week. Until next time.